Welcome to Rain King Insights, and thanks for watching this short video. In the GMU Extra Sun Shower series, we put together short-form videos on specific trading topics. And in this episode, we're going to talk about free trades. Again, the presentation is by Rain King LLC for educational purposes. Now let's talk about how do we get free trades. In all trading, risk management has to be absolutely our number one priority to protect our account. We always want to have a trading plan where we know where we're going to enter a particular trade and where we're going to exit. Now, what I'm going to show you is really geared towards a swing trading time frame. And generally, that is positions that you hold for maybe 1 to 7 days to catch a short swing in a stock, sometimes longer, sometimes shorter. Now, every trade, we define risk as R. When we put on a trade, we define how much risk we're going to take, and we call that R. And we also try to get a reward, which will be a multiple of the risk that we're taking. So if I were to simply start a game on a coin flip, random distribution, and every time that heads came up, you would lose $1. But if tails came up, I would pay you $2 when you were right. So you're risking R, but your reward for every time you're right is 2R. So in a sample, if we took 10 flips, assuming they were equal distribution, 5 of the flips paid you $2 each for a total of 10, and 5 flips went against you, and you lost $1. You can see that the net is a positive number for you. And over the long run, if we keep playing this game, you're going to be profitable. It doesn't mean you won't go through losing streaks with statistical variance. You might have 5 flips in a row that go against you, even more once in a while in a particular series. But over the long run, the odds should give you a distribution that you will be profitable. You never really need to know what's going to happen next for sure, because the odds are stacked in your favor because you're getting multiples of your risk. Very important concept in trading. So risk management is number one. Now we talk about you really need an edge in your trading. It's a simple triangle. 3 sides of the triangle represent your average gain, your average loss, and what is your batting average or what is your win rate. So you need to know these statistics for your specific trading. So you have to track these. And when you get 50, 100 trades under your belt, and eventually you'll probably have thousands of trades under your belt, you'll have a very good statistical analysis of generally how you trade. What is your average gain, loss, and how often are you right every 10 trades? Are you right 3 out of 10 trades, 5 out of 10 trades? You need these numbers because they're very important to understand the next concept. So when we build a trading plan, we want to build that plan around our numbers, our own numbers. So in this theoretical example, we're going to assume that your average gain on your stocks, each gain has an average gain of 10%. Your average losers are 5%. And let's assume your batting average is 500. You're right half the time. So in this situation, you're a 2-to-1 trader. Your gains are twice your losses. You're a 2-to-1 trader. So if we look at this row, 2R, you're a 2-to-1 trader. And we come across and it intersects with the win rate, your batting average. We talked about the batting average is 500. So you're right 50% of the time. The intersection of these two basically tells you if these numbers, batting average, loss, and gain, can be profitable over time. In this case, the box is green, meaning it's profitable. So if you maintain your numbers, so to speak, you'll be okay over the long term. You can see some combinations don't work. If you're a 2-to-1 trader, but you're only right 2 out of every 10 trades, 20%, you can see that's an unprofitable combination. So you've either got to get to a 3R or 4R trader, or you've got to get your win rate higher. Lots of combinations work, but you need to know what works around your specific trading numbers. So how do we get a free trade? Well, here it is. Who wouldn't want to have a free trade? So let's look at this particular example. Someone who is a 2-to-1 trader, their average gain is 6%, their average loss is 3%, and they have a 50% win rate. So let's assume you're buying a breakout. Stock's in a cup with handle, it breaks out, you buy your position at $100 per share. And let's assume in this example, you're going to use a 3% stop loss, or 3 points, because it's a $100 stock, 3 points is 3%. That's R. That's what you're willing to risk on the trade. So how we get free trades goes like this. As soon as the stock moves up a multiple of your risk, in this case, 2 times your risk, 2R, if the stock moves 100 to 106, this is 2 times your risk. You took a risk of 3%, and the gain currently is at 6%, 2R. At that point, you're going to sell half of your entire position and pocket those gains. Then what we're going to do is we're going to move your stop loss up to break even and get a free trade. And the way we do that is once the stock reaches this point at 106, we're going to move our stop up to break even. That's our new stop loss. So we still have half the position with a stop loss at break even. So in this example, the stock keeps moving up. You have an option. You can either sell the stock at 3R, which is actually a 9% gain. You could sell the stock there and bank another gain. Or you could actually, the worst case scenario would be if the stock does not keep going up and it turns down. The worst case scenario is you're stopped out at break even. So even though you're stopped out at break even, you still made the first half of the trade was positive. So you've made money and you protected the downside. And essentially the second half of this position was a free trade. If it worked, that would be great. But the worst case scenario was you would break even. So you're getting a free trade. Let's look at another example. In this example, we're going to look at a 3-to-1 trader. The average gain is 15%. Their average loss is 5%, 3-to-1, and they have a 40% win rate. Let's assume they're buying some sort of downtrend line. They buy their position at $100 per share. In this case, they're going to use a 5% stop loss, which is consistent with their average loss. Stock moves up to 110. Keeps going, it noodles around, there's some reactions, some pullbacks, but the stock keeps moving. We don't sell half the position until we've made a multiple of our risk. Again, we're looking to be a 3-to-1 trade. So as the stock gets to 115, that's 3 times our risk. That's where we're going to sell half the position and bank our gain. Then we're going to move our stop up to break even. And because there's so much room between 100 and 115, we're going to move the stop to break even plus 5%. So we'll show that on the chart here. We're moving our stop loss up to 105. The stock is at 115. So at this point, you have a free trade. Stock could keep moving. Let's say it moves up and you get 5R. You get 5R, you could sell the rest of that, and you have a really good gain on this trade. You made 3R to here and another 5R on the second half. Again, maybe the stock noodles around and starts acting funny, and you don't want to let it go too far, and you just sell the rest of the stock essentially at this area, which is 3R. So you've completed the full trade at a 3R gain. That's a good outcome as well. In the worst case scenario, the stock flops over and crashes down. If it does that, you're going to be stopped out. But remember, your stop loss is break even plus 5%. So even the second half of this trade made 5%. So you take those gains and you take your 3R gains from here and you put them together to complete a pretty good trade. That's another free trade. It's actually one of the secrets of profitable trading. Particularly, it works well when you're using a swing time frame and you know your numbers really, really well. The whole key is, how do I get as many free trades open as possible? Because if you can take profits off the table and have free trades, you've only got upside, barring a gap down, and then things might get into a loss situation. So if you just use your stats, average gain, loss, and batting average, you can develop a winning trade plan. You bank your gains along the way as a multiple of your risk, and you're managing risk all the way. So we've talked about how you get free trades. If you like this content, check us out at Rain King Insights. We'd love to have you as a member. All of our GMU Extra Sunshower series are free videos for all members, free members of our site. So it doesn't cost, I think it costs $1 to join the site. So take advantage of that content, and we'll see you all on the next GMU Extra episode.